Well, welcome everybody to our webinar on all you need to know about generational wealth transfer. Today, we're going to have Wilmot George Jr. from the tax and estate planning team at CI Global Asset Management joining us. Wilmot's going to give us about 40 minutes of deep dive knowledge on wealth transfer. We do have a number of people that have signed up, and we also have a pretty long list of questions that we've already received, but we look forward to getting questions in line as well. We'll probably save the questions till the end of the webinar, just so you know, just so Wilmot can make sure that he covers what he wants to cover. Some of it will cover your questions, and whatever doesn't get answered in the webinar, Wilmot will be really happy to answer at the end. Questions make a presenter feel like people are paying attention and care about what they're talking about. So it's pretty good. We're pretty excited to have such a long amount of people signing up. We have 45 people or 47 people have signed up. Some of you will be joining by a recording, I'm sure. Some of you will be joining and watching this on our YouTube channel in a few days once we post it up there. But the attendee list here keeps growing. So hello to Aaliyah, Brian, Ford, Jacob, Linda, Minu, Paula, Peter, Robert, Terry, Tour, and Valentina. Hello to all of you. Hello to everybody else that's joining a little bit later or via YouTube. So without further ado, I think we'll just go ahead and I'm going to let this slide sit here on the screen for 30 seconds so that we can comply with whatever it is that compliance wants to tell you. If you're having trouble reading, please come back, sleeping one night, please come back to the slide. It'll put you to sleep right away, I'm certain, but it is important information. And I think that's 30 seconds, Leah. As a reminder, our team is currently comprised of 5 people, soon to be 6. We have our team founder, Jeff Wachman, who is unfortunately not able to join us today. But Jeff, as most of you at this point know Jeff, he has done an amazing job over the past 20, 25 years, creating our team and growing our practice. And so Eric and I thank him for that greatly. We have myself, then we have Erik Wachman, who is one of the financial planning advisors on our team. Many of you speak directly to Erik, and those of you who haven't had a chance to meet Erik, I highly recommend it. He's a great guy and very personable. There he is. We have Leah Zeidman, who is our associate. Leah handles setting up things like these webinars and our presentations. She's the one behind all the pretty emails that we send out. Leah basically keeps the whole place running and also handles a lot of the client services stuff. One of our newer team members, who many of you have probably had a chance already to interact with, but hopefully you do, is Anna Maria. Anna Maria joined us in March, helped us through tax season, and has been quickly getting up to speed on client service type questions. Anna Maria joins us from Ukraine and loves horses. And then we do have one more team member joining us slowly over time, and she'll get added to that slide that we were just on, which is Joan, and you'll learn more about Joan later in another email. So today we're really lucky to have Wilmot George join us. Wilmot is basically the team lead on the tax, retirement, and estate planning team at CI Global Asset Management. This means that he knows a lot of stuff, and it also means that he's pretty expert in a lot of questions that our clients tend to ask. And we have a few more people joining. Hello, Robert. And Wilmot, as you can see, has about 18 different qualifications and so forth, and I'm not going to go through all those, but you can read those on your own. He is a member, he has presented to the Institute of Advanced Financial Planners before, and of course that's an organization that's dear to the WWH team's heart. So thank you, Wilmot, for presenting there. And both Wilmot and Erik actually just got back from the STEP conference, which is the Trusted Estate Planner conference, and I think they learned a ton there. So without further ado, nobody really came here to listen to me talk about who we are and what we do. What you came here to do was to see Wilmot speak, listen to his excellent presentation style. We can all learn a bit from that. And you came here to ask him a bunch of questions, which you already have. But any other questions, please put them in line in the Q&A section or the chat. We promise to ask them at the end, and we'll see how Wilmot does in our version of Jeopardy. So away you go, Wilmot. I will be quiet now, and thank you so much for joining us.
Can you guys see my screen there? It should say Family Matters Intergenerational Wealth Transfer. Awesome. Thank you guys for this opportunity to be with you. I always enjoy these forums, having a chance to come together and have a chat about things that really matter. So thank you to all our attendees. Thank you to the WWH financial team. Appreciate the partnership. This stuff really does matter. Family matters, intergenerational wealth transfers. This topic is a very big topic nowadays, and will continue to be a very, very big topic for the next number of years, because, you know, we have the baby boomer cohort, the largest generational cohort, according to the Department of Finance, well into their transition into retirement, joining the matures. And we'll take a look at the generational cohorts here in this presentation. But the matures and the baby boomers are in that place now where they're enjoying their retirements, and they're thinking about ways to share their wealth, right? So this presentation is all about sharing the wealth, right, within the family, how best to do that. And there's a number of statistics that suggest why we need to be having this conversation. So credit to the WWH financial team for bringing this conversation to you. I hope you find this presentation useful. We'll do a Q&A period at the end, time permitting, and for whatever questions that might come up after that, or if I'm not able to answer your question on the spot, it'd be my pleasure to work with you through the WWH financial team to get answers to your questions. All right, so let's get right at it. Our agenda for today, we're going to talk about the wealth landscape. Money is on the move. And again, I mentioned that there's some statistics that bear this out, right? That support this. So we want to take a look at what the wealth landscape is. Where is that money today, and where is it going? And then we're going to get into the types of transfers. This presentation is about intergenerational wealth transfers. So we're going to talk about how to move money across generations, right? But when we do that, when we talk about types of transfer, very often we go directly to the assets. We go directly to the money. We go directly to the real estate, the real property that we have. We go directly to the non-registered assets and the RSPs and RIFs, and we should. But let's not forget that knowledge transfers has a place as well. So we're going to talk very, very briefly about the power of knowledge transfers, and then we're going to get into those asset transfers. But even within that section, the asset transfers, you know, there's a difference between lifetime gifts versus gifts at death. So what we're going to try to do is peel the onion skin back a little bit, and we're going to look at lifetime transfers. We're going to look at transfers at death. We're going to look at some of the considerations to be mindful of when we're thinking about and planning for those types of transfers, and we'll see where we end up. Okay, so that's our agenda for today. So let's take a look at the wealth landscape. At the end of 2020, and this is sourced by IG Private Wealth, a group out there that did some research in this area, and this is what they've said. At the end of 2020, total assets of Canadian households, excluding any pension type benefits, right, were estimated to be $11.9 trillion. Right, so at the end of 2020, total assets for Canadian households, excluding the defined benefit pension assets, right, that'll pay you out on a monthly basis in retirement, we'll exclude those for a minute. We're estimated to be $11.9 trillion. That's a lot of money. And Canadian households are figuring out how best to handle that wealth. A lot of that wealth is going to be handed down to the next generation. But in order to talk about the transition of wealth to the next generation, what are the generational cohorts out there? We often talk about boomers and Gen X and the millennials. Well, what are those groups really? What ages define each of those cohorts? Now, this slide here is sourced by Statistics Canada. And they define your matures as those who are age 78 or older, right? This is current to 2023. Your baby boomers are those 77 to 58, right? So I mentioned that the baby boomers are well into their transition into retirement. I think this slide bears that out, right? For your typical traditional retirements, 55, 60, 65, and so on, we can see that the baby boomers are well into their transition into retirement, joining the matures and the traditionalists, matures or traditionalists. And then we've got Gen X, those ages 57 or 43 to 57. Then you got your millennials, age 27 to 42, and so on and so forth. So a large portion of this wealth that we're talking about, this transition of wealth, this $1 trillion that we keep hearing about that's going to be transitioned over the next little while here, and I got another slide that's going to speak to that in a minute. A lot of that wealth is held by the matures and the boomers. And the matures and the boomers are trying to figure out how best do we transition this wealth? Because as much as we love the government, we don't want the government as our partner in our wealth, although they are to a certain extent. Right? They're going to want their share. Okay, we give them their share. The question is, what is the fair share? And is it okay to plan your affairs in such a way that minimizes tax payable? Is that okay? For sure, it's okay. Tax planning is fine. There's nothing illegal about tax planning, as long as you follow the rules of the Income Tax Act. All right? Tax avoidance is something different. Tax evasion is something different, but tax planning is fine. So when we talk about, growing our wealth, we often talk about managing our wealth in an effective way from a tax perspective as we're accumulating it, but we also want to manage it appropriately and minimize taxation as we're transitioning that wealth as well. And this is the stuff that the WWH financial group or financial team will help you with when you sit down and talk to them, right? So that's a look at the generational cohorts. But watch this. Let's talk about this great wealth transfer. We often hear about this great wealth transfer that is happening. What is this all about, right? And I think that this slide here does a good job at describing what this great wealth transfer is. This is sourced by Maclean's magazine, right? And it says the ongoing transfer of wealth. This is the great wealth transfer. It's the ongoing transfer of wealth that will see approximately $1 trillion passed on by baby boomers and Gen Xers. Passed on by baby boomers to Gen Xers and millennials by 2026. This is the largest intergenerational transfer of wealth in Canada's history, and one that will make millennials Canada's wealthiest generation ever. That's a big stat. It's a big comment, a big quote, right? Approximately $1 trillion is going to be passed on by the baby boomers to Gen Xers and millennials by 2026. That's around the corner, right? And it will make the millennials Canada's wealthiest generation ever. So we have to think about that. We have to plan for that to ensure that we're maximizing the amount of wealth we can transfer to the next generation. Again, the government is a partner in everything we do financially, but there's nothing wrong with tax planning to minimize their share. Okay, but this wealth transfer isn't just for the individuals. It includes family businesses as well. Many have been talking about, this is PwC speaking here now, many have been talking about the big change that will hit the business world as the baby boomers retire. Now it's finally happening. The owners and leaders of Canadian private and family businesses have started to exit the workforce in huge numbers. And business valuations are at record highs. The result is an unprecedented transfer of wealth and responsibility. They went on to say 70% of private and family business owners are planning to sell or pass on their business over the next few years. 70%. Okay, so this transfer of wealth we're talking about, yes, it includes your RSPs and RIPs. Yes, it includes your non-registered investments. Yes, it might include personally owned real estate, but it also includes for many their businesses. That's a big conversation. Are we going to transfer the business within the family? Are we going to transfer the business outside of the family? When is the right time to transfer that business? What if I rely on cash flow from that business to fund my retirement? What will that look like? That's all part of this conversation. It's an important conversation to have. All right, so now that we've kind of set the stage, let's talk a little bit about types of transfers. There are knowledge transfers and there are asset transfers. When we talk about asset transfers, we can break that down even further. There are asset transfers that take place while living, and there are asset transfers that take place at the time of death. So what we want to do today is we want to talk a little bit about knowledge transfers, and then we're going to talk about asset transfers. And the goal here today is really just to point out some things to be mindful of, some considerations to keep in mind. My goal here today is not to solve all your problems or questions about intergenerational transfers. And I can't. It's because everybody's situation is unique, right? And some of the strategies that we talk about here today will apply very well to you, and some of them will not. But my goal here today is really just to point out some things at a very high level to inspire and promote some thought and conversation around this topic, and then the deeper dive can happen between you and your WWH financial team. Okay, so let's get at this. Let's talk a little bit about knowledge transfers, because this often gets overlooked when we talk about intergenerational wealth transfers. We often go right to the assets, but there is value in what is in our brains, right? Knowledge transfers. Do not forget, please do not forget to transfer your knowledge to those you love and care about, right? Give a fish and feed for a day, teach the fish and feed for a lifetime. I try to pour into my son as much as I can, right? As I'm sure many of you do. You try to pour into your kids as much as you can. And sometimes they listen, a lot of times they don't, right? But as I speak to him, as I talk to my son, I hope, and you know, every day when I wake up, I hope he's catching a little bit more of what I have to say, right? Because I tell him all the time, I'm not always going to be here. I'm happy to support you, but I'm not always going to be here. You got to take certain teachings, you know, and I remember my dad has since passed away. He passed away in 2020. But I remember growing up, we used to go fishing with my dad. And he would be teaching us to fish, physically teaching us to fish. But in addition to that, though, while we were out there and we were fishing, we were talking, we were having conversation, we were talking about everything under the sun. When you're out there for hours trying to fish, you talk and you talk and you talk, and the knowledge transfer is happening, right? So when you think about intergenerational wealth transfers, please don't only think about the asset transfers, which are important, and the bulk of our presentation will be focused on that, but also think about what is in your mind and the value that you have to deliver to those who are coming after you, you know, through your experience, right? Okay, so what are the benefits of knowledge transfer? Shared learnings, obviously, promotes dialogue, and that dialogue is important because it creates an opportunity to assess needs and wishes. It also creates an opportunity to potentially avoid conflict after death. We see it all the time. Confusion and conflict that can happen after death. I'm going to talk about a couple of those situations as we move through the presentation, right? But if we have these conversations well in advance and we plan accordingly, there is the opportunity to avoid conflict. right? And also these knowledge transfers, these conversations that we'll have that allow for the transition of knowledge will allow us to bridge or allow us a bridge to centers of influence, right? Because quite often when you're talking to your loved ones about the transition of wealth, somewhere in that conversation, a reference will likely be made to your financial advisor. A reference will likely be made to your tax and your tax advisors and your legal advisors. And what that's doing is it's giving some insight into your family members, giving them insight into who your trusted professionals are, and points them in that direction should they choose to go that way, right? So knowledge transfers are important. I encourage you to pour into those who are coming after you, not only with your assets, but also with your experience in that regard. Okay, let's move on. Let's talk about asset transfers. Let's talk about lifetime transfers first. This is a growing and growing and growing area. Years ago, when we talked about intergenerational wealth transfers, we were quite often talking about the estate planning conversation, right? We were talking about what happens at the time of death and how best to transition assets at the time of death. Well, we've seen, and certainly in recent years, and perhaps even longer than that, this growing market of lifetime transfers. People are giving away money before they die, for good reason in a lot of cases, right? Many of these folks want to see their kids and grandkids enjoy the wealth. Many of these folks want to assist with the high cost of living, right? How many young families are struggling to buy a home in the region or area that they wish? How many young families are struggling with the cost of groceries even nowadays, right? And quite often they're turning to parents and grandparents who have resources to help them with that, right? So many folks are gifting assets while living because they want to assist with high costs of living. Many folks are giving while living because they want to provide access to certain markets, housing market, want to help with the starting of a business, something along those lines, and they want to support young families. There's a survey that was done in 2021, and it ranked the major areas for high net worth lifetime transfers, right? So a lot of folks are helping the next generation with education. They're helping with the purchase of a first home. They're helping with cars and living expenses and new businesses, and some are even helping with the purchase of vacation properties, right? So these are areas that that folks are looking at and have a keen interest in helping the following generations with these costs. Okay, fine. So if that's the case, and we want to do a deeper dive then on lifetime transfers, what are some of the strategies that are available to assist with these lifetime transfers? Well, RESPs have been around for as long as I can remember, and I've been in the industry over 20 years, right? So certainly contributions to RESPs continue to be possible and are a great way to provide for the education for kids, grandkids, whatever the case may be. They provide your grants and in some cases bonds and so on and so forth. I'm not going to get into the details there. The WWH financial team can help with that. Gifting of capital appreciating assets to minor children or grandchildren. And the reason we talk about gifts of capital appreciating assets is because this speaks directly to tax planning. You see, you can't just gift assets to certain family members and then turn around and walk away and have that future, have that gift generate income in the future and have that income tax to that person. You can't do that in all cases, right? You can do it in some cases, which we'll talk about, but not all cases, right? So when we talk about gifts of capital appreciating assets to minor children or grandchildren, right? We want to think about capital gains as opposed to income, as opposed to interest, as opposed to dividend income, because capital gains remain taxable to minor children and grandchildren. They're not caught up in the attribution rules if done properly, right? If the gift is structured accordingly. So we'll talk more about that in a minute. Gifts to adult children for contributions to TFSAs and other registered plans. Sometimes the kids don't have enough money to contribute or don't have the resources to contribute to their TFSAs or their RRSPs or perhaps they don't have the resources to contribute to this new FHSA, First Home Savings Account, that has recently been made available, right? So there are opportunities to gift assets to adult children so the children can make those contributions to those registered plans. We can make gifts by way of inter vivos trusts. We'll talk a little bit about trust as we move through the presentation, but there's a difference between what we call testamentary trust versus inter vivos trust. Inter vivos trusts are trusts we set up while we're living. Testamentary trusts are trusts that we set up via our will, usually at the time of death. So when we're talking about gifting while living, there's an opportunity to gift those assets, perhaps not directly to our kids, perhaps not directly to our grandkids, but we can gift to them by way of an inter vivos trust. Now, inter vivos trusts aren't necessarily an Income Tax Act savings vehicle because there's very little income tax savings that are created by virtue of the trust. But what they do is they allow for control. Trusts are generally a control vehicle. So they allow you to control how the asset is distributed in the future. And they might also allow you to avoid some probate fees at death.
Wilmot, I promised to save all the questions to the end, but real quick, an inter vivos or inter vivos trust, that's what a lot of people call family trusts as well, right? Is that the same thing?
Not necessarily.
No. Okay.
Not
Gonna keep
necessarily.
watching that.
Yeah, you only really have two types of trusts, inter vivos trust and testamentary trust. Now, within those two buckets, you can have different types of inter vivos trust. You can have different types of testamentary trusts. A family trust is just a generic term that's used to describe a trust that's set up for the family. And that family trust can be an inter vivos trust, or that family trust can be a testamentary trust. All right. So the term family trust is really just, it's not a defined term under the Income Tax Act. It's just a term that folks use to describe, the purpose of the trust. All right. Okay. All right. So there are inter vivos trusts. Joint ownership might be a way to gift assets before death. There are some risks associated with joint ownership. We'll talk about that in a minute. And then for your business owners, you can do estate freezes. I'll talk more about that in a minute as well. So we don't have time to talk about all those strategies, right? We'd be here till 6 o'clock this afternoon if we do a deep dive on all these strategies. But I do want to touch on some of them. But before I do that, it's important for us to look at the attribution rules. The attribution rules are rules defined by the Income Tax Act that say what we can and cannot do when it comes to gifting assets to a close family member. It's not that I can't gift assets to my spouse or common law partner. It's not that I can't gift assets to my minor children. It's just that if I gift assets to my spouse or common law partner, or I gift assets to my minor child, and they generate income from those gifts, the question is, who's that income, that future income, who's that going to be taxed to? Is it going to be taxed to my spouse or common law partner? Is it going to be taxed to my child? Or is it going to be taxed back to me through attribution? And the attribution rules are designed to prevent those situations where I'm splitting income within the family solely to save taxes. So if I gift assets to a spouse or common law partner, and the spouse or common law partner takes those assets and invests them and generates interest, dividends, or capital gains, guess what? According to the attribution rules, that future income gets taxed back to me. So we're no further ahead from a tax perspective than if I didn't give the gift. With my minor child, If I gift assets to my minor child and my minor child invests those assets, any income, interest, and dividends get taxed back to me. Capital gains remain taxable to the minor child. Which is why I talked earlier on about gifting capital appreciating assets to minor children. Capital gains normally remain taxable to the minor child. Well, what about my adult kids? Well, I can gift assets to my adult kids without having to worry about attribution at all. So this in and of itself is an income splitting opportunity. If I've got an adult child, 18 and beyond, I can gift them whatever I want. And there's no attribution of future income. It remains taxable. The future income remains taxable to them. So that's an income splitting strategy. And it is also an intergenerational wealth transfer strategy that can minimize taxation. All right. Okay. Now, let's move on. Gifting capital appreciating assets to minor children. I talked about this. The attribution rule does not normally apply to capital gains with minor children or grandchildren. So it creates an opportunity to split capital gains with minors. There's different products out there designed to generate primarily capital gains. I'll let the WWH financial team speak to you about that. Gift to adult children, right? And we can do this directly or by way of a trust. I've mentioned that gifts to adult children do not trigger attribution. I can gift to my adult child, future income is taxed to them. But perhaps I don't want to gift assets to them directly. Perhaps my adult kids are spendthrifts. Perhaps my adult kids are dealing with disabilities and can't appropriately manage money. Perhaps my adult kids have creditors or are part of an unstable relationship, and I don't want to gift assets to them directly. Well, what we can do is we can gift assets to them by way of a living trust, an inter vivos trust. We can set up that trust. We can name a separate trustee to manage the trust on their behalf, and the trustee can have discretion or no discretion, meaning that the trustee can make decisions, or I can spell out specific terms and conditions for the distribution of the assets. And I can still achieve multiple objectives, either directly or through the trust. We can still achieve income splitting. Where we use the trust, we can minimize probate fees. Where if we don't use the trust, we still minimize probate fees because I will no longer own those assets at death. They will not flow through my estate. They do not become subject to the probate fees. Trusts allow me to control distributions to beneficiaries, and then they can also provide some protection from creditors if my beneficiaries have some creditor issues and perhaps unstable relationships. The trust may act as a protection vehicle in those circumstances, right? So again, when we talk about intergenerational wealth transfers, we want to be mindful of different ways for us to transfer that wealth. We can do it directly, or we can do it by way of trust. Now, how do these living trusts work? You know, a settler, myself, for example, I have property, I want to transfer to this trust. I go to a lawyer, I draft up a trust document. The trust document will spell out the terms and conditions for the trust. I transfer property into this trust. The trust holds the property. The trustee can manage the property accordingly and pass the assets out to the beneficiaries when time permits. At a very high level, that's how it works. The pros of the living trust: it encourages discussion, avoids probate fees because they do not flow through the estate at the time of death, can guard against creditors. I can provide specific instructions. They can allow for privacy. If my will gets probated at death, that becomes a public document. I may not want the world to know what I have when I die, right? So by using an inter vivos trust and transfer assets to trust before death, then we can maintain some privacy. If it's a real property, principal residence exemption may or may not be available depending on the trust. The cons, of course, depending on the type of trust, there might be some taxation on the way into the trust. It's a separate entity, has to file a separate tax return. I'll skip the 21-year deemed disposition rule. That just means that it would be taxed in 21 years if we don't trigger it earlier. And trusts are taxed at the top tax rates normally, okay? So those are the pros and cons for that. Jointly held property. I'm not going to spend a ton of time here, but it is certainly important to talk about jointly owned property because a lot of people do it, okay? A lot of people do it. A lot of folks approach their financial advisor, approach their banks, and they say, hey, look, I've got this solely owned non-registered account, for example, and I heard that I can avoid some probate tax by putting the account in joint name with my adult children. Okay, and that can be effective. It can be an effective strategy because if I establish an account jointly with my adult child when I die, in theory, that account bypasses my estate and avoids the probate tax. Okay, fine. The problem is, though, depending on my family dynamics and depending on how many kids I include in this joint relationship, it can potentially cause confusion and conflict after death if I'm not clear about what I want done with that asset when I die. Because the joint owner, let's say, for example, I've got 3 kids and I list this property jointly with one. When I die, that one joint owner may very well feel like I intended to leave the account to them solely. My 2 other kids might feel, no, that's not true. Dad intended to leave the account to the 3 of us. He just put your name on it solely because you see him every day and you handle his financial affairs. Right? And if they can't agree, and if I passed away and I can't clarify my intentions, then we've got conflict within the family. So in order to avoid the conflict within the family, it's a good idea to have conversations around any jointly held property and perhaps document in writing what your intentions are for that account so that it is clear what should happen when you pass away. All right, we've talked about this example in the past. This example just described what I just talked about. A mom, Mary, had some money, had 2 kids, Beth and Kim, put Beth on as a joint owner because Beth is close to mom, helps her with her day-to-day affairs, all that stuff. Kim lives farther away, is not close, to help with the day-to-day, but loves mom equally. Mom died. Beth, wanted the account for herself. She believed she was the sole owner and she's entitled to it. Kim said, nope, mom would have wanted that account divided between the 2 of us. And then they had a fight, right? And so these things happen. The courts often have to get involved and determine who's right, who's wrong. They'll often look at evidence. What evidence do we have that suggests what mom wanted done? And they make a decision, right? Based on precedent that has been set in the past. So joint accounts are often considered to be very simple. They can be on the surface, but when you peel the onion skin back, they've got some complexity to them. All right, I'm coming up on my time, so I'm just going to go just a shade quicker here, just get to some key points here. Family cottage has some considerations as well, particularly where you have multiple kids, and can those multiple kids share ownership? While I'm living or at the time of death? When is the right time to transition that family cottage, right? Do my potential beneficiaries have an equal interest in owning the property, right? And if not, how do we equalize the estate? These are all very, very good questions. It's important to address these questions with your financial advisor and with your legal team to ensure that the cottage gets handled appropriately. We can gift assets while we're living. We can sell assets while we're living. If you gift assets to your kids, quite often you're deemed to have disposed of that asset, and that can trigger some capital gains tax. But sometimes that's okay because you're going to pay the tax anyway. And if you trigger that tax before you die, then perhaps you have an opportunity to trigger it at lower tax rates if you're not traditionally at the top tax rate. When you leave assets to dispose of them when you die, quite often you're subject to tax 54% in Ontario, which is the top tax rate, because you're deemed to have disposed of or sold all your assets at that time. All right. So gifting or selling assets prior to death can be an effective strategy. For the business owners, you can consider an estate freeze as a lifetime transfer type strategy. You want to exit the business, you want to retire, you've got kids are going to take over, but you still want to have an interest in the business, even though you're no longer going to be working in the business. Well, you can set up what we call an estate freeze. An estate freeze will freeze the value of my interest in that business today. I will still own shares of that business, but the value of that business is frozen. If it's worth $2 million today, it will stay at that value. And any future growth will accrue to what we call growth shares that are issued to my kids. So my kids can run this business on a go-forward basis. Any growth will accrue to their growth shares. I still retain an interest in this business through my frozen shares. I can still receive dividends. The kids can receive dividends, but it's a succession planning strategy. They can be quite complex, so you'd want to do a deeper dive with the WWH financial team. Okay, let's talk about asset transfers and death. I think I got maybe another 5 minutes or so. 5 or 7 minutes or so. Thumbs up. Okay, good. So let's do asset transfers at the time of death. When we talk about estate planning, there quite often are certain goals that we're trying to achieve. Those goals might include clearly communicating intentions, simplifying estate administration, minimizing income taxes and probate fees at the time of death, providing appropriate support for dependents, which might include spouse or common law partner, minors, or family members with disabilities, or perhaps we want to navigate blended family scenarios, right? These are some common goals that folks often speak to when they are looking to establish their estate plan. Now, these strategies, estate planning strategies, might include having a will. This one gets overlooked more than you know. Everybody talks about having a will, but not everybody has a will, right? And when you don't have a will, you're deemed to die intestate. So the government doesn't take your assets, but they define who will receive your assets, right? Based on your family tree. And that may or may not align with your wishes. So having a will is important. Understanding the rollover rules for RSPs and RIFs. To whom can I transfer my RSPs and RIFs on a tax deferred basis? How will named beneficiaries for registered plans help? You're often told, put named beneficiaries on your RSPs and your RIFs and your TFSAs and your insurance contracts. And I agree with all of that. In most cases, not all, but in most cases. Those assets, when you have named beneficiaries, normally bypass your estate, and it can be a probate planning strategy. Testamentary trusts. We talked about inter vivos trust earlier. Testamentary trusts are trusts set up at the time of death. Quite often, you would need to include a provision in your will to get that set up on your death. And then there are some business owner strategies to be mindful of: lifetime capital gains exemption to minimize taxation, multiple will strategy to avoid some probate, and depending on the company and your wishes for it, post-mortem planning to avoid double tax at death. All right. The importance of a will, as mentioned, if you don't have a will, the government will define who will receive your assets based on a formula, and that may or may not align with your wishes. Okay, so having a will clearly indicates your intentions and goes a far way towards ensuring that those intentions will be carried out. If minor children inherit directly, which is what can happen in the case of no will, a surviving spouse may require the consent of the public trustee to gain access to those assets for the kids. Adult children who inherit directly because of the absence of a will may request the sale of a family home to fund their inheritance, which can be a potential problem for a surviving spouse. And also, when children inherit directly, perhaps because of the absence of a will, you're accelerating your tax bill because there is no rollover generally to children like there is with a spouse or common law partner, tax deferred rollover. So there's reasons to have a will, and we strongly suggest that. Named beneficiaries for RSPs and RIFs. When you have a named beneficiary on these plans, it bypasses the estate. And when it bypasses the estate, quite often you avoid the probate process and probate fees. Now, in considering named beneficiaries, particularly for RSPs and RIFs, and I think I'll close here with this one example, and then we'll get to questions if there are some questions. Named beneficiaries for RSPs and RIFs, again, we support that strategy, but you always want to be mindful of where the tax bill is going to land. Okay? Because if we're not familiar with where the tax bill is going to land, and we don't plan for that tax bill, then it can frustrate families after death. And let me give you an example of what I mean. So at the time of death, May had a RIF, and the value of the RIF was $400,000. Now, as per her RIF application, May had named her daughter Grace as the beneficiary. Now, May also had a will, and she named her other two children, Jacob and Charity, beneficiaries of her estate. You see, her kids here, Grace, Jacob, and Charity, didn't always get along. And May was thinking, look, just to avoid conflict after death, to keep things separate, I will leave my RIF to Grace, and I will leave my estate to Jacob and Charity. They're both equal to about the same amount, will be equal to about the same amount, so I'm going to handle things that way. Now, May's will made no reference to her RIF. Shortly after May's death, Grace approached the RIF issuer and requested payment from the plan. The issuer paid Grace the full $400,000 and issued a T4 RIF, which represents the tax bill, issued a T4 RIF to May's executor, which required $400,000 to be included as income on May's final tax return, with the tax bill payable by her estate. So the result here is that Grace, the beneficiary of the RIF, received $400,000 free of withholding tax, received the full proceeds, while Jacob and Charity paid the taxes for the RIF via a reduction of their entitlement from May's estate. How do you think Jacob and Charity felt about that, right? So these are the types of things that can happen. So it's important for, in thinking about your estate plan, have conversations with your financial advisors, have conversations with WWH financial team to get a full understanding of the strategies and the potential implications from strategies that are set up, so that you can avoid challenges like this if these challenges have the potential to present themselves in your families. All right. So with that, I think I'm at my time, but I think there's an opportunity to address some questions here. I'm turning it back. Am I turning back over to Eric or Per, or who am I turning back over? Eric?
I'll take it over from here. Thanks, Wilmot.
And we'll go from there.
Beautiful. All right. Well, thanks, Wilmot, for giving us that landscape. I mean, there's a definite amount of strategies that we can delve further into. But the goal today is really to expose all of this with our clients and see what resonates. And if there is an area or a strategy that you heard about that you'd like to look at into further detail, please do reach out. We'd be more than happy to look at that together and see how that fits into your plan. So with that aside, a few of the questions that came up, and we did receive a fair number of questions from our participants throughout. One that we often get as well relates to the transferring the ownership of the family cottage. We mentioned that one of the slides that you looked at today, George, Wilmot, but I wanted to delve into that. Simple question that we had here, and let's start the discussion. What's the least financially challenging way to transfer ownership of my cottage to a child? Maybe we'll start there and see where that takes us. And not to be a trap question, but let's start there.
What is the least financially challenging way to transfer the cottage to kids? That is Correct. A big question, right? and in an ideal world, we would love to be able to transfer the cottage to the kids tax-free, right? In an ideal world. The problem is the way our tax system is set up, our tax system doesn't like tax-free intergenerational wealth transfers, right? They just don't, it doesn't, right? Our system, because if you think about it for a minute, if we were able to transfer assets across generations tax-free, then at what point will the government receive their tax?
Correct.
Right? So the system is not set up to allow us to transfer cottages, for example, to our kids on a tax-free basis. A cottage is no different than your non-registered assets. it's deemed sold at death. If you have a spouse or common law partner, you can transfer it to your spouse or common law partner on a tax deferred basis. When your spouse or common law partner dies, there's a tax bill, right? So question is, are there any opportunities to minimize tax payable on transfers to kids, right? And some of the things that we often talk about is I'll talk about a couple of them. The PRE, principal residence exemption. Now, when you think about the principal residence exemption, quite often you think about your primary home, your city home, right? And we know that family units, right, can claim a principal residence exemption in respect of one property that they occupy as their principal place of residence, right? And regardless of the growth in that property, you get that property tax free upon sale or at the time of death. Now, there's nothing in the Income Tax Act that says that you cannot use that principal residence exemption for the cottage instead of your primary city home, right? So we have seen situations in the past where a family has a cottage that has appreciated in value far more than perhaps their city home. In that particular case, it might make sense to claim the principal residence exemption against the cottage as opposed to the city home, pay less tax with the city home than you would with the cottage, and that can be an effective way to transfer the assets to kids, right? There's formulas, calculations, and all of that you would need to go through. Some might say, well, do I need to occupy the cottage on a consistent basis? Consistent, yes, but not in abundance, right? So the government has said that I can go up to my cottage and spend a week or two a year there, and that would still entitle the cottage to the principal residence exemption in respect of that year. So there's some flexibility there, right? The other thing we talk about with cottages and transferring cottages to kids, a question might be, okay, well, what am I going to do here? Am I going to gift the cottage to the kids, or am I going to sell the cottage to the kids? Right? Mm-hmm. And if I sell the cottage to the kids, what will that look like? Right? I can certainly gift the cottage to the kids. I'm not going to talk about transfer taxes. I'm like land transfer taxes, that type of thing. It's not really my area, right? But if you're going to gift assets, gift the cottage to the kids, there's a tax bill, assuming you're not using the principal residence exemption. There's a tax bill to the parent at that time. Kids would receive that cottage with an adjusted cost base that's equal to fair market value. So they'll pay tax on a go-forward basis for appreciations of capital in that cottage. But the parent has to report the full tax hit for the year of sale or the year of the gift, right? If I sell the cottage to my kids, the first question is, do they have the money to pay for it? Right? And they might not. But just because they don't doesn't mean that you still can't sell it to them. In fact, we have seen some families sell cottage to kids and sell it to them at fair market value, but the kids are not required to pay all the proceeds up front. They draft up some type of agreement that says that the kids will pay for the cottage over time. And what that allows the parent to do is it allows the parent to spread out the tax bill over a period of up to 5 years. Because we have something called the capital gains reserve strategy here in Canada, and it says that if you're selling property to someone, which can include your kids, and you're not going to receive full payment up front, you're going to receive payment over time, then you can spread out your tax bill, spread out your capital gain over a period of up to 5 years. Right? So you can look to engage that kind of a strategy. And hey, guess what? Because it's not an income earning property, right? You don't necessarily need to charge interest at fair market rates. If it was an income earning property, it's a different conversation, right? And in many cases, we see the parents forgive that particular loan, right, at the time of death too, right? So there's some different things that you can do to try to minimize tax payable. Avoiding tax payable outright is hard to do. All right.
And then lastly, on that point, can you just comment on the rules of trust and insurance in relating to, say, moving, passing a cottage or property of that style on to the next generation? I mean, it's a strategy that we've looked at, but maybe some preliminary thoughts on trust and insurance in using those as a strategy.
Yeah, you certainly can use trust and transfer a cottage to a trust. There's no harm in doing that. The thing to keep in mind with trusts, and it's not just with the cottage, right? It's any asset that's transferred to a trust. You wouldn't use a trust to save income tax. It's not its primary purpose. In fact, um, most trusts are subject to tax at the top tax rate, so it can be punitive from a tax perspective nowadays, right? The reason you use trust is for control reasons, right? So the idea here is, I want to leave the cottage to my kids, but my kids don't necessarily get along. So what I want to do is spell out how this cottage is to be used, after my passing. So I'm going to set up a trust. I'm going to name a separate trustee, and the trustee is going to manage the cottage that my kids can use over time, right? For example, right? Or you know what? I'm in a blended family, and myself and my second spouse here use this cottage quite a bit. But upon my second spouse's passing, I want this cottage to go to my kids from my first relationship, right? You can use a trust to achieve that. So you can see that trusts are used typically as a means of control, to ensure that certain things happen after your passing, right, with that asset. Insurance, I always like to talk about insurance because it's important, right? And quite often, in most cases, the payout of insurance is tax free, right? So it's great. So what is insurance used for? Typically, it's used to extinguish tax bills, right? It's used to extinguish tax bills. It's used to pay debts. It's used to preserve wealth for beneficiaries, because tax bill can eat into that wealth, right? Debts can eat into that wealth, right? Or sometimes, you want to provide for a family member who isn't going to have, or doesn't have the potential to have, a significant stream on a go-forward basis. So we use insurance for that, right? So there's different ways that you can use insurance. We often see insurance getting put in place in order to preserve the family cottage, right? Because if I, as a parent, I'm going to walk into a tax bill in respect of that cottage, and this is a cottage that's been in the family for generations and generations and generations, and I want it to stay in the family, then what can compromise that strategy is a significant tax bill. My executor will be required to sell the cottage to pay the government their taxes. So in order to ensure that that doesn't happen, maybe I put some insurance in place to extinguish that tax bill so that the cottage comfortably can be handed down to the next generation. Okay, so both trust and insurance have their place in estate planning, and they can certainly have their place when you're doing your cottage planning.
That's great. And one thing I wanted to also remind everybody is trust seems like a sexy term, but everybody forgets there's a rule about a 21-year deemed disposition, meaning that every 21 years a time bond ticks off and capital gains have to be paid on whatever properties in the trust. So that's something that's often forgotten when thinking about that. And I mean, thinking about putting a cottage in a trust and you then have to pay the taxes anyway in 21 years, it's one often forgotten aspect that can derail the whole strategy altogether. So thanks for pointing that out and explaining it. The last one I'll say before we wrap up, testamentary trust. Wilmot, do you have any last things to share about when should one use a testamentary trust, when that's helpful, and how those are created? And we can leave everybody on that thought.
Sure. Testamentary trusts are great vehicles too. The thing to keep in mind, one of the primary differences between an inter vivos trust, which that's the setting the trust up while living, and the testamentary trust, setting it up at the time of death, is the living trust is quite often used as a probate savings technique, right? Like you set it up before you die, you transfer the property to this trust. It avoids your estate when you die, it avoids the probate fees. Testamentary trust will not avoid the probate fees, right? Because a testamentary trust is set up at the time of death. So the idea here is you die, the assets become part of your estate, and then your executor then takes the estate assets and puts it into this testamentary trust, which is normally, the terms for the trust is normally included in the deceased will, right? So a testamentary trust is a trust that's set up at the time of death. Whether an inter vivos trust is better or a testamentary trust is better, it just depends on the circumstances. Depends on the family dynamics. It depends on the objectives. If the objective is not to save probate fees, then you can look at a testamentary trust. There are some folks that say, look, I don't want to create a trust before I die because this is my asset and I want to continue to own and control this asset until I die. I might need to use this asset down the road. People are living longer. Some retirements now are 35, 40 years, right? And I don't want to create a trust before I die. I want to have this asset in my name until I die. And then at that point in time, I want to put it into a trust and have some say over who's going to get that trust over time, right? So in that type of scenario, a testamentary trust might work great, right? Family might say, hey, look, I might say, hey, look, I've got a family member who's dealing with a disability. And while I'm still here, it's great. Everybody can use the asset. I'm the owner of the asset. But on my passing, I'm going to need to create a trust that's going to manage this asset for my family members with a disability. So testamentary trust can be a good fit there, recognizing that you won't avoid the probate, but you're creating this trust at the time of death. So, I testamentary trust, inter-Bibles trust, which is better? It just depends on the circumstances. But regardless, each of those trusts are used as a means of managing the asset after death.
Wonderful. So I think that's a beautiful spot to wrap up. On behalf of the WWH team, I want to extend a huge thank you to Wilmot, his expertise, and the tax retirement estate planning team that Wilmot is part of. So we're very fortunate to have them in our corner to help with these types of questions and to look at these individual scenarios. I want to thank everybody for participating today. Thank you for sharing this light afternoon hour with us. Hopefully you can get outside and enjoy some of the sunshine. If any of these ideas, strategies have resonated with you, and if you want to discuss further, please feel free to reach out, and we'd be more than happy to look at this and how it affects your scenario and your plan. And we'll also be sending out a copy of the video in case you missed anything, and we'll be posting it on our socials. That way you can share that or go back and look at any strategies that you want to learn more about. So with that, I will wish everybody a great rest of the day. Thank you for joining us. Thank you, Wilmot. Thank you, Per.
Thank you,
everybody. Stay well.
All
Yep.
right.
Thank you, Wilmot, for hosting, and thank you, Leah, for organizing this. We look forward to the next one.
Thanks, guys. Appreciate it. Bye-bye.